Gromen's joining us, founder, president of FFTT LLC. Luke, good to have you with us. The move yesterday, the reaction to the CPI, just looked at what we saw in terms of the 10-year, but we saw it in the short end as well, the 2-year from about 5% to 4.75. Is it a bit overdone?
Yeah, I think it probably is a touch overdone. I think it's you had sentiment all in one direction, but I think it's really important to remember. The last time we were talking on this show, Ben, I said that the beatings in duration will continue until the dollar's weakened meaningfully and oil is weakened meaningfully. And better lucky than good, I guess, or maybe I rang the bell at the top, but of yields, but. Oil proceeded to fall from 92 to 78 very quickly. Shortly thereafter, you had a number of different Fed speakers, 7 in 8 or 9 trading days, come out and say, the bond market has done our work for us and started jawboning the dollar down, in my view. And so we've seen the dollar pull back now from 107, obviously with yesterday's big move down in the dollar. So I think there's some mechanical things that once you get oil down enough, once you get the dollar down enough, you can bring back some, it takes away a lot of the selling pressure. So I think we're going to probably see more stabilization in these ranges. I don't think we'll see a whole lot of further downside given, on the margin, the economic data is weaker, but then again, you also have, you also still have issuance, even although they have pushed off longer-term issuance over the next quarter.
Luke, I was looking at some of the data here. It's not just CPI here in the U.S. We saw the numbers in the UK. They came in pretty good as well. I guess I'm wondering if we start to see this become a bit more of a trend here. Does it accelerate that move to the downside? If we expect to see further cuts coming in, maybe even sooner than expected, do we see continued weakness back down to those lows we saw earlier this summer even?
I suppose it's possible, really, because they've bought themselves some time. When you look at what the Treasury said 2 weeks ago with the Treasury Borrowing Advisory Committee report, their recommendations, which was, we have this issuance, we have this fiscal problem. There's 2 ways to deal with it. There is, we can term out, we can slash spending, which is the super bond friendly way of doing it, or we can shift issuance from the long end to the front end. And they shifted it to the front end pretty meaningfully over the next quarter. So that reduces some of the supply issues at the long end. And now you've got this reduced inflation, you've got the softer dollar, you've got softer oil. So they've set up a situation where you could continue to see some stabilization or follow through on the downside a bit. But again, only to the point where that weaker dollar and the stabilization in the bond market leads to a loosening in financial conditions, which has already started yesterday, and is going to feed back into better growth, higher inflation, more oil demand. So it buys some time, but I think the amount of time it buys, we're talking about in terms of a few months, not in terms of longer than that.
Luke, in terms of stabilization and follow through, I mean, as far as the dollar to the downside, maybe one could argue that we could continue to see that as far as inflationary pressures, right? Still above target. I think it's important to point out, and I like that you're kind of leaning on some of the Fed speakers. Earlier, I saw Goolsbee commenting on how this year we could see the fastest non-war related 1-year fall in CPI inflation in a century, basically, with unemployment that never gets above 4%. I guess in many ways, I think the real question here is, where does unemployment go at this point? Do you see, amidst all of this, these labor conditions remaining as strong as they have been, and the economy, for that matter, remaining as strong as they have been, or maybe this is a reflection of further weakness to come?
The short answer is I do expect it to unemployment to remain low and the economy to remain relatively strong for 2 reasons. Number one, federal deficits are still, on a trailing 12-month basis, 8% of GDP. And 8% of GDP deficits with unemployment this low are stimulative, full stop. The second thing is, to the extent the dollar stays lower, that rates stabilize, you're going to get you're going to get a better stock market. The stock market's likely to go up. And as the stock market goes up, it will, on a lag, contribute to tax receipts that reduce the deficit somewhat. However, more immediately, it's going to add to demand. It's going to add to GDP. And so I think we're likely to see the economy accelerate from here, which then factors back into that point about bond yields of how much follow through can we have. I look at what happened yesterday, and I think it's. In fact, we wrote about it 2 weeks ago for clients. If you get the dollar down, it's good. It's actually good for bonds. It's good for the long end of the Treasury curve. However, it's a suboptimal way to express it, because I think what we're about to see is the stock market go up a lot more than what the what the TLT is going up, for example, or what the 10-year bond price is going up. And that then gets you right back into the question of, why am I buying bonds if the stock market's rising rapidly? But that's a question for another day. But you can kind of see the reflexive feedback between these two issues in this moment of time where we're at.
As Tom White was walking out of the studio after the first segment, he was talking about it. He was a little bit surprised that the yield curve didn't come in a bit. It expanded. He said 210, still around this minus 32 level, but he thought after the numbers yesterday, we would have seen that play out a little bit more.
Yeah, I guess, any given day, it's hard to kind of know how much of it's mechanical versus a view towards, what the economic outlook is. I keep going back to what I think is still very underappreciated, what Treasury said a couple weeks ago, which is there's a developed market way to handle a fiscal problem, which is cut issuance. When you have a supply-demand problem in the Treasury market, the developed market way to deal with it is cut issuance and take the economic pain. The emerging market way to deal with it is shift to the short end and just finance it on the credit card. And critically, we shifted it to the front end and are financing on the credit card. So what does that mean as it relates to the yield curve? It ultimately suggests growth and inflation are likely to secularly remain much stickier than people think, which to me, again, it feeds back into that my initial view of I think we've got the downside on the bonds probably a little overdone. Once people kind of take a breath and say, okay, the fact still remains that we are moved to a much more emerging market way of financing our deficits. The deficits aren't going to shrink much. If anything, they're going to keep growing. And so that ultimately should get us back in a few months' time to this sort of steepener, right? Of, oh gosh, growth is higher. Oh gosh, inflation's rising again. Why is that happening? And then the long end sells off. We get some steepening action, and we kind of reevaluate at that point. But there's a lot, there's a lot that can happen between here and there.
Luke, lastly, the data due out here in just a couple minutes. PPI retail sales, how telling will the figures be, and what should we be looking for?
I think they're probably pretty important just from the standpoint of what we've got already from the softer than expected jobs report for October, the slightly softer than expected CPI report for October. You have Nick Timmerhouse, the Wall Street Journal yesterday, out tweeting that sort of the Fed's done, and now they're trying to figure out how to word how they're going to stand pat. So if either of these numbers come in really hot or both of them do, that probably throws a bit of a spanner in everything that's happened over the last few days. But on the other side, if they sort of confirm the coolness of the prior numbers, then I think you probably get further downside in 10-year yields. You probably get further upside in stocks. You probably get further downside in the dollar, and we kind of continue on this move.
All right, gives us something to keep an eye on here. We've got the data headed our way in just about 2 minutes. Luke, appreciate you sharing part of your Wednesday with us to talk financial markets and the response we're seeing here to the CPI data yesterday. Luke Gromen joining us this morning, founder and president of FFTT LLC.